Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Great, so we're going to go ahead and get started. I just want to thank everyone for attending today, and thanks to Dan Passarelli for presenting today. Welcome to the ISE webinar. Today's session will be hosted by Dan Passarelli, who will be teaching us about analyzing vertical spreads. Author and options educator Dan Passarelli is the founder of Market Taker Mentoring, LLC. Dan began his options trading career as a market maker on the floor of the CBOE, trading equity options. He's also traded agricultural options and futures at the CBOT. Dan is the author of Trading Options Greeks and has also written numerous articles for financial publications. So we'll turn it over to you now, Dan. Thanks.
Hey, thank you very much for the kind introduction, and thanks a lot to the ISE for allowing me to come and spend some time with everyone today. I hope that you guys are excited about this presentation as I am, because this is a topic that I really, really kind of like giving. I really like talking about vertical spreads. And they're specifically interesting in the context of currencies or ETFs. But really, you know, a lot of what we talk about here can transcend to really any asset class, whether it's equities or indexes or even commodities. Vertical spreads are really, really kind of cool spreads. A lot of people kind of look at them in a very, very simplistic way, and you know, sadly, I would go as far as saying sometimes we look at them the wrong way. They are deceivingly, there's deceivingly a whole bunch going on here that a lot of people don't always appreciate, and so that is going to be the gist of our presentation today. Now, I want to point out, excuse me, I want to point out before we get going here, there is my website here, markettaker.com. Please feel free to peruse my website. There's much free education there. Take a look at that. And become one of the people who follow me on Twitter, twitter.com/Dan_Passarelli. Better write down Passarelli. That's stuff on some people's belt. I've got a lot of people that follow me on Twitter. I give a daily option tip, and I really like to interact with traders such as yourselves via the social media. Now, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Don't have a copy of characteristics and risks of standardized options? No problem. I'll tell you where you can get one. You can go to the Options Clearing Corporation. You can call them right here with this phone number, 1-888-OPTIONS. Or there's a physical address here that you can take a look at too and write them a letter, and I'm sure they'd be more than happy to send you a copy of the options disclosure and disclaimer documents. But you know, this slide is not just fine print legalese. I like to kind of take a break here and just make sure that everybody knows what we're doing here. Here's what I'm doing here today, and here's kind of like the raison d'etre of my life for the past several years. I'm not giving advice. I'm not telling you what the latest and greatest best stock pick in the world is, or options pick, or whatever. I don't think that you're looking for that. I don't think you should be looking for that. I'm trying to teach my students, and today you guys, how to be self-reliant. Knowledge is power, baby. And that's what I'm trying to provide here today, is to give you some of the knowledge that I've gained over the last 17 years in the options industry, having been a market maker for a long time in options, and since having taught and written quite a bit about options I'm trying to impart knowledge so that you don't need these guys who send you these spam emails that say, hey, follow my secret trading system, or, you know, trade my picks because, you know, I'm right 110% of the time or some business. You don't want that. You don't need that. You want to be self-reliant, and that's what we're trying to accomplish here today. Okay, step down from the soapbox carefully, and let's get into today's presentation and start imparting some of this knowledge. Currency trading and options. Did you know that in some form or another, currency trading is by far, I mean hands down, the largest form for trading in the world? Has been for a long time, is likely to continue to be for a long time. The notional value, or, you know, kind of like monetary value that is traded just on a simple daily basis in currency options is humongous. I don't know if I put the figures in here or not. I forgot, but I mean, it's just humongous. It's a very liquid market. The spot market is, you know, just simply trading, you know, currencies versus currencies. The futures market also has been a big forum for trading currency for a while. And just over the past several years, innovations by the ISE allowing a very, very simple, very liquid, and very fungible options contract on a securities market has really made currency trading just a much, much more flexible vehicle to trade. There's tons of opportunities. There's, you know, a good handful of currencies, and boy, oh boy, is there always something or other going on. To provide you with opportunities to trade currencies, whether it's interest rates or politics or some sort of combination of the two. So you do have a lot of options with your ISE currency options, and you can visit ISE.com and you can take a look at a list that's like this, and you know, that kind of covers all the tradable currency options that are available to you. You can kind of trade them both ways, you know, like there are some currencies that are traditionally stated, you know, one currency in terms of the other. Well, you can kind of trade them both ways here with some of them, like the Australian dollar, British pound, the euro, and even the New Zealand dollar. So I'm presuming that if you're attending this presentation that you probably know a little something about currencies. And really where I provide the most strength is to show you how the options part of it works. You know, I'm kind of presuming that you've got some sort of base knowledge of currencies, base knowledge of interest rates, and you understand that part of the world somewhat. But here's where people get into trouble. They get into trouble when they start trading options and they do it naively. They start trading options and they hear their buddy tell them, oh, listen, credit spreads are the best thing in the world to trade. And they say, huh, well, I want to trade credit spreads. That sounds great. My friend told me that they're great spreads, and they don't really learn exactly how they work. And you know what happens? They screw it up, and they screw it up really badly, and they lose money. Options, in my opinion, are probably the absolute best trading vehicle out there, because you can set up strategies to trade very conservatively or very aggressively, or trade things other than, you know, just simply direction. You can trade time, you can trade volatility. They're incredibly versatile, but, you know, you got to learn a little something about them first. So here's what we're going to do. We're going to specifically cover vertical spreads today. And chances are you may have some questions throughout this presentation. Now, if you do, here's what you should do. You should go down to where it says Q&A or down to where it says chatties, and I guess sometimes people do that. And type in a question, and the good people here at the ISE have told me that they are going to send them all to me at the end of the presentation. So that's how it'll work. Kind of, if you have a question during the presentation, hey, you don't want to forget it. Go ahead and type it in now. We're going to hold them all until the end, and then I'll spend as much time answering them as I can. So I kind of touched just a teeny bit on this. There's a lot that you can do with options, and that's because there's a lot of different ways to combine options. When you combine two or more options into a single trade, we call that a spread. And the reason is because typically spreads reduce risk. And often they can do them in such a way where you can actually increase the potential reward. So now, hold on a second. Wait a minute. If you've traded the spot currencies or futures in currencies, you know, you've probably studied all these techniques to kind of, you know, try and reduce risk, like using stop orders and cut your losses fast and let your profits run. You know, on gap trading, those things don't always work. None of those things are fail-proof, but you know what? Options are. If you have a limited risk position, you can set up a trade in such a way where you know exactly what your risk is, and it is limited to some very certain amount, and in many, if not most cases, it's typically a much smaller risk than you would have if you were trading futures or if you were trading the spot currency. You can shape your risk and improve your risk-reward structure. You can hedge. That is, you can trade with protection. You can lower your capital expenditure. You can lower your option, or well, you can trade just your option-centric risk. Now, that's kind of a mouthful right there. But this is kind of what I touched on just a little bit before. You don't always just have to trade simple direction. Now, that might sound kind of like a weird kind of statement if you haven't had too much experience with options yet. But options allow you to exploit the time factor that's inherent in the contract. All options expire at a certain point. They get worth a little bit less as time passes. Certain strategies allow you to capitalize on that and make money as time passes. Some strategies allow you to make money if the underlying currency moves in either direction. So this is sort of option-centric risk that's only inherent in options that you can't trade if you're trading a future or the underlying spot currency. Okay, so let's talk kind of specifically here just about spreads. There are two types of vertical spreads. There are credit spreads and debit spreads. Now, part of this presentation, there's kind of like a punchline at the end, if you will. It's not necessarily intended to be humorous, but this presentation does kind of all lead up to sort of an intellectual climax at the end of this presentation. A very bold assertion to some novice traders. And that assertion, I'm going to kind of ruin the punchline a little bit here for myself, but I want you to be kind of thinking about this as we go through the presentation. Two types of spreads, debit spreads and credit spreads, and I'm going to tell you right here and right now that debit spreads and credit spreads are actually the same thing. Now, those of you who are, you know, kind of advanced novice people, you know, maybe close to intermediate, you may be somewhat familiar with debit spreads and credit spreads and have an opinion that perhaps one's better than the other or something like that. And by the time we're done with this presentation, I'm going to show you how there's a little bit of a flaw in that logic. So make sure you don't go anywhere. Now, for people who are brand new to vertical spreads, we're going to talk first about the credit spread. Again, two types of vertical spreads, debit spreads and credit spreads. The first one is a credit spread. A credit spread is when I sell a call, and it's usually an at-the-money or out-of-the-money call, and then I buy a higher strike call with the same month on the same underlying asset, in this case, currency. A put credit spread, the other type of credit spread, is when I sell a put, usually at or out of the money, and I buy a lower strike put within the same month on the same underlying currency. So it's two options, either both calls or both puts, but it's one trade, okay? So it is, as I've defined already, a spread. So now again, what we're kind of doing here is we're, kind of giving a little bit of a crash course for people who are novice, but this is not going to remain a basic level seminar for a very long time. So, don't, if you're intermediate or advanced, don't start getting bored yet, because you're going to like what I have to say at the end. With the call credit spread, because we're selling an at or out of the money call and then buying a higher strike call, here's how it works. The potential reward comes from the call that we sell. Why? Because I kind of mentioned already, as time passes, options get worth a little less. So what if we sold a call that was a little out of the money, and it stayed out of the money all the way until its expiration date? What happens to that call? Well, I'll tell you what happens to that call. It expires, and it disappears, and it no longer exists. But what does exist is the premium that you sold the call for. That stays in your account. It's yours to keep forever, or until you spend it. So all the reward in a call credit spread comes from that call that you sold. You want it to become worth less. Now, if the call becomes in the money, at the end, at expiration, if the call is in the money, you might get assigned on that call. You might get a short stock position, and you might not make money at all. You might lose money. So not only is all the potential reward coming from the short call in this spread, but all the potential risk is as well. You can kind of draw a line in the sand with call credit spreads, and I'm literally going to show you the line, not in the sand, but on my slide here in just a minute. You can draw a line in the sand and say, if we are below this price at expiration, I win on this trade. If I am below, or if I am above this price at expiration, I lose on this trade. So the stock doesn't necessarily, the currency doesn't necessarily have to go lower. Sometimes it could just stay right where it is. It just can't go higher. So I like to refer to a call credit spread as not necessarily a bearish stance, but more as a not bullish stance. When currencies are trending lower, or perhaps they're a little overbought, or maybe they're stuck in a channel towards the high end of the channel. When there's no expected news coming out, like, their central bank is not planning a meeting tomorrow or something, it might be a very appropriate strategy. Or when there's some mildly bearish news on the country or on the currency itself in whatever way. And for those of you who are advanced, you'd want to trade a call credit spread if you're bearish on volatility. Now, I said you have two options that are in the same expiration month, but boy, oh boy, what month do we choose? Right now, the fun month is May options. Should we trade May, or should we trade June, or should we trade something even further out in time? Well, here's what you need to do. I'm going to give you kind of two rules of thumb for deciding which months to choose. You should choose options that have 3 weeks to 2 months until expiration. Once again, and as it shows here on the slide, 3 weeks to 2 months until expiration. Now, you can feel free to violate that 3 weeks rule. But the fact of the matter is, you'll probably have a hard time finding a good spread that has less than 3 weeks until expiration. If you can find one that looks good and the risk-reward makes sense to you, and it has less than 3 weeks until the options expire, knock yourself out. I'm all for trading nice short-term credit spreads. The shorter, the better, really. But sometimes the risk-reward isn't there. You can potentially only win so much, and the risk is too great for what you can win. More than 2 months until expiration, you've just got, too much time. There's a time component to credit spreads. You need time to pass in order to profit. If you're putting on a credit spread that takes a whole year until expiration, geez Louise, anything can happen in a year. It's impossible to predict, what's going to happen with a foreign currency a year out, or at least it's pretty darn tough, because politics and economies and things change. Furthermore, options that are at the money or close to the money, they have a nonlinear rate of time decay. That is, shorter-term options have a higher rate of time decay than longer-term options. Because you want the option to get worth less, you'd rather have it get worth less faster. So options that have more than 2 months until expiration, their rate of time decay is just too low. It doesn't really make too much sense, and it doesn't work for you. So rule of thumb, 3 weeks to 2 months until expiration. Now, okay, this Passarelli guy, he's sitting here telling me sometimes the risk-reward doesn't make sense. What the heck is he talking about? How much, of an option premium do I need to collect on these to make it make sense from a risk-reward standpoint? Well, that is somewhat subjective and situational. However, you can kind of start with a nice little rule of thumb here as well. You should try and collect at least 10% of the spread width. So, if the spread width is, say it's an equity option. The spread width is $5. It's like a 55-60 call spread. Then you want to collect at least 50 cents when you sell this credit spread. Then, by the way, for people who are, totally wet behind ears here and saying, what do you mean collect when you make the trade? This is a spread where when you put on the trade, you don't actually pay for it. You actually get paid to make the trade. But at some point, you'll have to either buy that spread back or simply let it expire, and you need the price to go down in order to not lose money. You get a credit when you make this trade. You get money deposited into your account, but you have the spread that is a potential liability. So, rule of thumb, you want at least 10% option premium in relation to the width of the spread in terms of the strike prices. Okay, so I told you we're going to have kind of a line in the sand here. There's two options, so therefore there are two strike prices. There's the strike price of the option you're selling, and there's the strike price of the option you're buying. Now this is just sort of a precursory look at this. We're going to look at a very specific situation in just a minute, but I kind of want to make everybody a little bit comfortable here with what we're doing. This is called a P&L diagram, short for profit and loss diagram, and specifically, if we really want to call it the right word, it's an expiration P&L diagram. This represents what happens to the value of the option spread if you hold it all the way until expiration. Once expiration rolls around, the option has no time value. It has only what we call intrinsic value, or value in terms of, what it would be worth if assignments and or exercise occurred on those options. The vertical axis, or the x-axis, that's the price of the currency at expiration. And we don't know what that's going to be. We can speculate on what it is, but we really won't know until expiration actually occurs. And so that's sort of the one variable here in this chart. Now, the vertical axis, or the y-axis, that's contingent upon the value of the currency at expiration. This is your profit or your loss. So, for example, if the price of the currency is, let me grab my pen here. If the price of the currency is here, then that means we have a profit of coinciding with this point right here. If the price of the currency is, here, then we'd have a loss coinciding with this right here.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.